Today we're taking a look at Chapter 5 in my book, Audit Risk Assessment Made Easy, and Chapter 5 has to do with entity level controls. Now in the next chapter we're going to take a look at the transaction level controls, but today we're looking at more general type internal controls. They're all important, but I find that most auditors tend to focus on the activity level controls and they don't give the entity level controls appropriate attention. So if you've ever studied COSO, there's 5 components of internal controls in COSO, and you see those embedded in the audit standards, and we're going to look at really the first 4 of those activity level controls, which is the fifth component we'll be looking at in Chapter 6. So what are those 5 components of internal controls? It's control environment, risk assessment, monitoring, information and communication, and then control activities. So we're looking at these first 4 today. And let's begin with control environment. Most of the time when you hear people talk about control environment, they're talking about the tone at the top. We're really trying to determine whether or not management and those charged with governance, whether or not they're honest people. Hopefully if they're not honest, we didn't receive them as a client. In other words, during client acceptance, we determined they were not honest and we said, sorry, we can't do your audit. As you look at the control environment, the tone at the top, hopefully what you're seeing is that these people are honest and that they want to do what is right. Now, you know, when you're looking at honesty, that's a pretty intangible trait. So if you look at me, you might be thinking, is Charles Hall an honest guy? Well, if you don't know me, it may be hard for you to determine whether or not I'm honest. But with a business, it has a personality as well. It has a constitution as well. And we're trying to determine whether or not the business, and specifically the people who run the business and govern the business, whether or not they're honest people. So some of the ways that we see this honesty component manifested in a business is through a code of conduct. So we'll ask, do you have a code of conduct? How is that code of conduct communicated, and how often is that code of conduct communicated in the business? Is this something somebody signs on day 1 as they're hired and they never see it again? Or is the code of conduct emphasized in the business in a continuing manner, and maybe the key employees are signing this code of conduct on an annual basis after they go through some training, for example? One question you might ask in looking at the control environment is, how often does the board meet? So sometimes you'll look at a small entity and it never has board meetings. That's not a good sign. So for the entities that you audit, hopefully you're seeing the board meeting at least on a quarterly basis. The number of times that they're meeting tells you a lot about how serious the governing body is in terms of providing leadership to the entity. If they're not meeting, they're really not serious about providing leadership to the entity, and that tells you something about the control environment. Are the board members competent? Usually they are, but I have done some audits where I looked at who was on the board and it was not good. Now I said it in the last video, I'll say it again. Why are we doing this? Why are we even concerned about the control environment? Because we're trying to see whether or not these controls would have an effect on the risk of material misstatement. So how would control environment affect whether or not there's a material misstatement in payables? Sometimes I think auditors think there's not a relation there, but there is a relation there, because if you've got a board that hires dishonest people, say in accounts payable, or they don't monitor or do risk assessments in regard to the payables process or the receivables process, then your risk of material misstatement goes up. So there is a connection between the control environment and the risk of material misstatement in transaction areas. Another question we might ask in control environment is, do they sign a conflict of interest statement? If there's a conflict of interest, you want the board members and personnel within the entity signing these conflict of interest statements that would disclose any relationships the business has with that person. Now, the second component we're looking at is risk assessment, and I find that some auditors get this confused because they immediately start thinking about audit risk assessment. That's not what we're talking about here. We're talking about risk assessment that the client does, that the business does. So the business or the client, specifically the accounting personnel, they're looking at their own accounting process and they're looking for the risk of material misstatement. So the client is doing this risk assessment before you ever show up to do the audit. And they're doing their own risk assessment and they're asking themselves, is there a potential risk of material misstatement in the financial statements? How might that happen? The way you're going to see this manifested in the business, the way that you as the auditor, you're going to know that risk assessment is happening, is you should see some type of reports going to the board or those charged with governance or to management, showing that somebody is looking at the potential risk of material misstatement, and then they're saying to those in charge that, hey, we've got a potential problem here in our accounting system that needs to be corrected because there's a risk of material misstatement. You also want to see, are they looking at their own internal controls? If there's an internal audit department, you're going to see probably reports about internal controls, and that's a plus. If you don't, they might be doing this risk assessment on an informal basis. So the smaller the size of the entity, the greater the chance is that this risk assessment is being done informally. The larger the size of the entity, the more probable it is that they would have their own accounting personnel vetting the system for potential misstatements. So the third element that we're looking at today is monitoring. And you'll see this occurring when reports are provided to the board or to management. And you should see this occurring every month or every quarter. And then you're looking at who's providing those monitoring reports. And we had talked earlier about key metrics in another video that the entity's looking at. And those metrics might be, say, cash flows from operations, or they might be net income on a monthly basis, or they might be the cash level, how much cash does the business have at this time. It might be inventory turnover. So those key metrics should be reported to the board and the management periodically, and they should be monitoring what's going on there. They should also be monitoring their own internal controls. The fourth element that we're looking at today is information and communication. This one may seem unimportant, but it's really important. So if you're doing risk assessment and you're doing monitoring, but you don't appropriately, or the client doesn't appropriately communicate, say, a significant internal control problem, then why do the other work to start with? So the client, their accounting personnel, should be vetting the internal control system periodically and then communicating to the board or to management about what they're seeing. So one thing I look at is your internal audit people should be reporting directly to the board and not just to management. Now in smaller entities you're not going to have internal auditors, and that's pretty common, but where you do have internal audit people, they should be accountable directly to the board if possible. Now the fifth component, and we won't go into much detail here because this really gets into the next chapter, and this is where you really get into the nitty-gritty. It's really where auditors spend most of their time looking at internal controls, and we'll be looking at this component as it relates to specific transaction cycles in the next video. Make sure, regardless of the risk assessment work that you do, that when you identify a risk material misstatement, that you bring that in to this form in your audit file. So in the next video, we're going to take a look at activity level controls. That's chapter 6 in my book, Audit Risk Assessment Made Easy. So I'll see you next time. Until then, God bless and take care. Bye now.